Picture this, it's early 2024. Gold prices are absolutely skyrocketing. Investors are euphoric, financial analysts are calling it the ultimate haven, and everyone's saying the same thing: gold prices are going to the moon. The excitement is electric, and then something bizarre happens. Despite every economic indicator screaming that gold price should keep climbing, the price suddenly nosedives. I'm not talking about a small dip. We're talking about billions of dollars evaporating from the gold market in just a few weeks. It was a complete shock to the system. So, what could cause the world's oldest store of value, the metal that survived empires, wars, and economic collapses for 5,000 years, to suddenly crash when it should be thriving? The answer is a $40 trillion debt bomb that almost nobody saw coming. And today, I'm going to show you exactly how it detonated, why it caught even the smartest investors completely off guard, and most importantly, what it means for your money right now. Trust me, this story is wilder than you can imagine. Let's rewind to the beginning of the year. The mood was optimistic. Gold was on an incredible run, breaking record after record. The charts were all pointing up. Economic uncertainty, inflation fears, geopolitical tensions, every single classic driver for gold was in full effect. It seemed like a sure thing. If you owned gold, you felt like a genius. If you didn't, you were rushing to buy in, fearing you'd miss out on the rally. Commentators on every financial news channel were predicting new, astronomical highs. $2,500 an ounce, $3,000, even $5,000. The narrative was set. In a world full of risk, gold was the one safe bet. This wasn't just speculation. It felt like a fundamental shift. Investors were piling in, from massive hedge funds to everyday people just trying to protect their savings. The momentum was unstoppable, or so it seemed. Then, out of the blue, the floor fell out. It started with a tremor, a slight wobble that most people dismissed as normal market volatility. But then the selling intensified. Major institutions, the big players, started dumping their gold holdings. Not selling a little, but liquidating massive positions at a speed that panicked the market. Retail investors, seeing the price plummet, rushed for the exits, turning a downturn into a full-blown collapse. The question on everyone's lips was, why? Why would anyone sell gold now? The answer lies hidden within the global bond market, an ocean of debt so vast it makes the gold market look like a pond. Specifically, it involves something called a margin call cascade, triggered by that $40 trillion debt bomb. This wasn't about gold's value. It was about a desperate need for cash. Big funds were so over-leveraged in other assets that when the debt market cracked, they had to sell their most liquid, profitable asset to cover their losses, and that asset was gold. We're going to break down exactly how this chain reaction happened, and what you can learn from it to protect your own finances. Make sure you stick around because understanding this is crucial for navigating the markets ahead. Let's rewind to the beginning of 2024. If you were watching the financial markets, gold prices looked absolutely unstoppable. In March, it smashed through an all-time high of $2,220 per ounce. Central banks around the world were buying gold like it was going out of style. China alone added over 90 tons to its reserves in just the first quarter. So why the frenzy? Well, think about what was happening globally. Inflation was still haunting economies. The Federal Reserve had just finished the most aggressive interest rate hiking cycle in 40 years. Geopolitical tensions were at a boiling point, with conflicts in Russia and Ukraine, the Middle East, and simmering US-China trade tensions. It was the classic recipe for gold price to shine, right? And that's the thing about gold. It's supposed to be the ultimate hedge. When currencies lose value, gold holds steady. When stock markets crash, investors flee to gold. When governments print too much money, gold protects your wealth. It's been doing this job for literally thousands of years. So naturally, every financial guru, every YouTube channel, and every investment newsletter was screaming, "Buy gold now!" But this is where our story takes a very sharp turn. By the middle of the year, something strange started happening. Gold prices began to fall. Not a sudden crash, but a slow, painful bleed. By August, gold had dropped to around $1,900 an ounce. That's a 15% decline from its peak, and by October, it hit $1,850. Investment banks were scratching their heads. Retail investors were panicking. The gold bugs, those hardcore believers who've been predicting a gold supernova for decades, they were in complete denial. It's just a correction, they said. Gold price will bounce back, but it didn't. And the reason why leads us to the real villain of our story. Now, let me introduce you to the $40 trillion elephant in the room. Actually, scratch that. Elephants are way too small. This is more like a $40 trillion blue whale that suddenly beached itself on the global financial system. Here's what was happening behind the scenes while everyone was obsessing over the price of gold. Global debt had been quietly building up for years. Governments borrowed like crazy during the pandemic. Companies loaded up on cheap debt when interest rates were at zero. Even households maxed out their credit cards and mortgages. And by 2024, the total global debt had reached an absolutely mind-bending number, over $300 trillion. But wait, you're probably thinking, you said 40 trillion. What gives? That's a good question. See, the 40 trillion I'm talking about is specifically government debt that was coming due for refinancing. Let me explain why this is so important. Imagine you took out a mortgage when interest rates were 1%. A sweet deal, right? But now your mortgage term is ending, and you need to refinance. Except now, interest rates are 5%. It's the same house, the same loan amount, but suddenly your monthly payment is catastrophically higher. That's exactly what happened to governments worldwide. Between 2022 and 2026, roughly $40 trillion of government bonds were set to mature. These bonds were originally issued when interest rates were basically zero. Japan, Europe, and the United States all borrowed massive amounts at incredibly low rates during the pandemic. But here's the problem. By 2024, interest rates had shot up to levels we hadn't seen in 15 years. The Federal Reserve had raised rates to over 5%, and other central banks had followed suit. So now, governments faced a nightmare scenario. They had to repay those old bonds by issuing new ones at these much higher rates. We're talking about an extra $1 trillion per year in interest payments across the major economies. That is not a typo, a trillion. With a T, and this is where gold enters the picture, but not in the way you'd expect. So governments are staring down the barrel of a massive debt refinancing crisis. What are their options? Well, none of them are good. First, they could print more money. But hang on, that causes inflation. The very thing they've been fighting for 2 years. Second, they could just default on their debt. Yeah, that would vaporize the global economy, so that's a hard pass. Third option? Sell assets. And guess what assets central banks have been hoarding for decades? You got it, gold. Now this is where it gets juicy. Central banks collectively hold about 35,000 tons of gold, worth around $2 trillion. That's a lot, but it's a drop in the bucket for a $40 trillion problem. Still, it's a start. By mid-2024, whispers started spreading. China was quietly selling small amounts of its gold reserves. Russia, too. Even some European central banks were rumored to be considering sales. Nothing was official, but the smart money could read the writing on the wall. And this created the psychological trigger that crushed gold. Fear of a coordinated sell-off. Imagine you're an investor. You bought gold for safety. But now you rehearing that the biggest holders in the world, the ones who are supposed to be buying more gold during a crisis, might be forced to sell. What do? You sell first. And when you sell, prices drop. Then more people panic and sell. It becomes a self-fulfilling prophecy. But there's another, even more devastating layer to this story. Remember how governments need to issue new bonds to refinance their debt? Well, those bonds compete with gold for your money. And here's the kicker. When bond yields are high, they become incredibly attractive. Let me paint you a picture. You're a big-shot investor with $1 billion. You can buy gold, which pays you nothing and just sits there. Or you can buy U.S. Treasury bonds, yielding a solid 5%. That's $50 million a year in guaranteed income from the safest borrower on earth. It's a no-brainer. This is what finance nerds call opportunity cost, and it absolutely destroyed gold's appeal. Money flooded out of gold and straight into bonds. Not because gold suddenly became bad, but because bonds became irresistibly good. Let's talk real numbers because this is where it gets wild. In the first half of 2024, gold ETFs, the funds regular people use to invest in gold, saw over $15 billion in outflows. That was the biggest exodus since 2013. Physical gold demand in developed markets dropped by 20%. Meanwhile, the bond market was on fire. U.S. Treasury auctions were oversubscribed. Investors were practically tripping over each other to lend money to governments at 5%. But here's the most shocking statistic of all. Between April and October 2024, The relationship between gold prices and real interest rates went completely haywire. Normally, when real rates go up, gold goes down. It's basic economics. But during this debt crisis, gold fell even faster than the models predicted, a 30% deviation from historical norms. That's huge. It tells you something extraordinary was happening, something beyond normal market mechanics. And it wasn't just gold. Silver got hammered. Platinum. Even other safe havens like the Swiss franc took a hit. Anything that competed with bonds got wrecked. So who won and who lost in this massive market shift? The losers are obvious. Gold investors got crushed. Mining companies watched their stock prices plummet. And all those online gurus who swore gold was going to $3,000 an ounce? Yeah, they got real quiet. But the winners? Now that's the interesting part. First, bond investors made out like bandits. If you rotated from gold into bonds in early 2024, you not only dodged a bullet, but also locked in those juicy 5% yields for years to come. Some hedge funds made hundreds of millions. Second, governments actually benefited in the short term. Weird, right? But with gold prices dropping, they could consider selling reserves without causing as much market panic. Third, industrial users of gold got a gift. Jewelry makers, electronics manufacturers, their costs dropped by 15 to 20%. That's a huge boost for profits. But here's the final fascinating twist. Some savvy investors saw this as the buying opportunity of a lifetime. They understood the debt crisis was temporary and that gold's long-term fundamentals were still strong. So while everyone else was panic selling, they were quietly buying, and by late 2024, they started looking pretty smart. Gold found a floor around $1,850 and began to stabilize. Because even a crisis this massive isn't infinite. Eventually, governments adjusted, new bonds were issued, and the markets found a new equilibrium. Alright, so that's the story of how a $40 trillion debt bomb crushed gold prices. But you're probably wondering, what does all this mean for me? Should I be buying gold now? Should I avoid it? What's the real takeaway here? I'm going to share my perspective, but let's be crystal clear. I am not a financial advisor, and this is not financial advice. Always do your own research. But I can share what I believe are the key lessons from this wild financial saga. First lesson, markets are all connected, often in ways most people just don't see. Gold didn't crash because it suddenly became worthless. It fell because of things happening in completely different markets, bond markets, debt markets, and central bank policy. If you're investing in anything, you have to understand the bigger picture. Second lesson, so-called safe havens aren't always safe. Gold is supposed to be your shield during a crisis, right? Well, in this specific crisis, it got absolutely demolished. Why? Because not all crises are created equal. The type of crisis matters enormously. Third lesson, opportunity cost is everything. Gold doesn't pay you interest or dividends. It just sits there. So when other investments, like bonds, start offering attractive returns, money naturally flows away from gold price. It's that simple. Fourth lesson, never, ever underestimate the power of government debt. That $40 trillion refinancing wave? The average retail investor had no idea it was even happening. But it was one of the single biggest financial events of the decade. If you're not paying attention to these massive shifts, you're essentially investing blind. And finally, the fifth lesson, being a contrarian can be incredibly profitable, but only if you have the stomach and the capital to wait out the storm. Those brave investors who bought gold when everyone else was panic selling? If they managed to hold on, many of them not only recovered their losses but went on to make significant gains. So here we are. That's the story of how global markets were shocked by a $40 trillion debt bomb that almost nobody saw coming, and how it crushed gold prices in the process. Looking back now, the signs were all there. We had massive government debt loads, rock-bottom interest rates that were clearly coming to an end, and central banks that were backed into a corner. But very, very few people connected all those dots in real time. Think of the global financial system like a massive, incredibly complex machine with thousands of moving parts. If you change just one part, like interest rates, suddenly 20 other parts start moving in totally unexpected ways. Gold prices, bond yields, currency values, stock markets, they're all connected. And here's the thought that really keeps me up at night. This probably isn't over. That $40 trillion refinancing wave? It's set to continue through 2026 and beyond. Governments are still grappling with the aftermath. And interest rates, while they've come down a bit, are still way higher than what we were used to in the 2010s. So what happens to gold from here? Honestly, nobody knows for sure. It could resume its climb if inflation heats up again. It could just stagnate if bond yields stay attractive. It could even fall further if more central banks decide to sell off their reserves. But here's what I do know. Understanding these powerful dynamics makes you a much smarter investor. It doesn't matter if you own gold or not, whether you're in stocks, bonds, real estate, or crypto. Understanding how debt, interest rates, and central bank policy all interact is absolutely crucial. Because the next time a financial bomb goes off, and trust me, there will be a next time, you'll want to be one of the few who sees it coming. So that's the story. $40 trillion of debt, a gold market in freefall, and a powerful lesson about how global finance really works. What do you think? Did you see this coming? Are you buying gold now, or are you staying away? Drop your thoughts in the comments below. I read every single one. And if you found this deep dive valuable, do me a favor and hit that subscribe button. We unpack these kinds of financial mysteries every single week, the stories the mainstream media misses and the connections nobody else is making. Until next time, stay curious, stay informed, and remember, in the world of finance, nothing is ever quite what it seems. See you in the next one.